Simple, fast steps. Step number one, our story starts with Bretton Woods. Toward the end of World War II, the United States had the majority of gold. So the world needed a new monetary system. 44 countries came to Bretton Woods, and they decided that the solution was to peg the United States dollar to gold, or make it convertible into gold, and then peg their currencies to the United States dollar. That was countries like Australia, several in South America, Africa, the Middle East, and Europe. The problem with that was twofold. First and foremost, a lot of these countries didn't like the fact that if they got into financial problems, they couldn't devalue their currency. What a problem that would be. So they came up with a solution. That was the IMF and the World Bank. That brings us to this video's phrase that we're going to go back to over and over again. Hashtag unintended consequences. The unintended consequences from Bretton Woods started with more centralized power. And we know well today that these entities have way too much power. That all started with Bretton Woods. But going back to the issues with the currency peg and the United States dollar now being the world reserve currency, is it put us into Triffin's paradox, which basically means the United States has two options. First is to print enough dollars to maximize on the domestic economy, or print enough dollars so all the other world economies can grow at their full capacity. And a lot of times printing all of those dollars isn't what's best for the United States. So to get around that initially, because the United States back then was very cognizant about its money supply, all these other countries came up with a system. That system was the Eurodollar. This sounds complicated, but it's really not. As an example, let's use two countries and their central banks. And both of these countries are running under their full potential. This country, 50%, this country, 30%. And in their Keynesian minds at the central banks, they believe it's because they just don't have enough currency. And they want to try to figure out a way to inject more currency into the system, but they can't do that because their own local currency is pegged to the dollar. So what's the solution? Create more dollars. Down here, we know that under the central banks, they have main banks under that umbrella. We'll call it XYZ Bank in this country and ABC Bank in this country. And those banks create new money by lending it into existence. Well, if there's $1 billion in the system outside of the United States in this country, we'll call it Australia, and over here, the UK has $2 billion in their banking system, well, what prevents them from creating new loans denominated in dollars? Nothing. Also, there were no reserve requirements. So this $1 billion could turn into $40 trillion. This $2 billion could turn into $100 trillion. And those obviously aren't exact numbers, but the point is the amount of dollars that these banks could create was limitless. This is how they got around having their currencies pegged to the dollar. In other words, it's how they got around the problem of having a limited money supply. And I'm sure a lot of you watching this can start to understand the problem with this. We start to financialize the world economy. And how that works is they've got this money that they're multiplying, these dollars that they're creating out of thin air that exist outside of the United States system. Bank X loans dollars to Bank Y. Bank Y loans dollars to the Australian corporation that takes those dollars to fund several projects. Then Bank Z buys credit default swaps in dollars against this Australian corporation, and it lends dollars to the UK corporation. The UK bank, A, B, and C, they also create dollars, lend amongst themselves, maybe in their repo market or even their overnight funding. And then, of course, they take those dollar loans, they package them, they sell them to other corporations that put them on their balance sheets, that take those assets and lever against them in dollars to buy more products to grow their businesses. Oh, by the way, A, B, and C are doing dollar-denominated interest rate swaps between the UK corporation and the Australian corporation. You can see how the financial economy goes from this size to this size, which it was in 2007, and it's even bigger today. All of these financial shenanigans go right back to Bretton Woods. Hashtag unintended consequences. Then in 1971, this system breaks and we don't skip a beat. Why was that? Because at that time, the Eurodollar system had taken over. So we didn't have a dollar-based global monetary system. We had a Eurodollar monetary system. That's why in 1971, we didn't see an economic crisis. Fast forward to 1981, and we're in a perfect storm that we have never seen in history before. That's where we have this financialized economy, a fiat money system, and an interest rate down cycle for 40 years. In other words, the cost of money has been going down since 1981. When you combine all these things together, it's why we have all these asset bubbles, wealth inequality, and a derivatives market that is valued at over $1 quadrillion. It's just like Jeff Snider says, in the sense that our economy, the global economy, is just like a top. When it's spinning very, very quickly, it looks incredibly stable. But as soon as it starts to spin a little slower, it tumbles over. It was never stable to begin with. Step number 2, let's dive into the 2008 global financial crisis. It all starts with understanding why liquidity matters. And whenever you hear the term liquidity, all that means is cash, or in this case, dollars. So let's go right to the dollar funding markets. Our usual players are all here. Bank A, Bank B, Bank C, financial institutions, and hedge funds. The green bar represents the amount of cash that they have available, and the blue bar represents the non-cash assets. So to run their business on a day-to-day basis, sometimes they run low on cash. So they have to take some of their assets and use them as collateral to go into the dollar funding market. Another entity like this hedge fund that has a lot of cash on hand will say, okay, financial institution, we will take your collateral and we will give you the cash that you need. The liquidity problem is solved, but you can see how this allows them to take a lot more risk. And it creates a system that, quite frankly, is very shaky. More on that later. But to understand this even better, let's go over to our buddy Landowner Larry. And Landowner Larry is extremely excited right now. You can see that smile on his face. And why is that? Well, he's holding a sign here telling us that he just went to georgegammon.com and signed up for his email list. So he is never going to have this problem again. But what his problem is specifically is he's got 100 acres of land that is worth $10 million, and it appreciates by 2% a year. So he makes 200 grand a year on his investment, but it's only on paper. A lot of you are probably saying, well, George, that's a good problem to have, and I would agree. But unfortunately, Larry only has $500 in his bank account. He's got to pay rent. He's got to pay his car insurance. He's got to pay his car payment. So he goes to the bank and says, listen, bank, I am broke. I don't have the money that I need for my day-to-day operation. So the bank says, okay, Larry, we'll take some of that collateral. We'll give you the money they need. So Larry takes that money. He puts it into his account. Now he can afford to make his rent payment and his car payment. Problem solved. The bank and Larry have created their own miniature version of the dollar funding market. Now let's dive into how this works a little bit deeper so you can start to understand how everything you know about the global financial crisis of 2008 is wrong. To understand this plumbing, let's go right to the New York Fed's website. Okay, this is a diagram from the New York Fed's website, and I would strongly suggest going on here and checking this out when you've got some time. This is actually really awesome. Mapping U.S. dollar funding flows. And on the left-hand side, you can choose what directional arrows you want to see. Let's start with the Eurodollar lending. All of these entities, the prime money market funds, the corporates, the hedge funds, and European corporates and offshore money funds and foreign central banks, they all lend dollars to foreign banks. Well, what do those foreign banks do with the dollars? They turn them into new loans. In other words, they create new money supply, new dollar money supply with those loans. And let's say over here, down below my head there, where the arrow is, we've got corporations, we've got all these multinationals that are European-based, Japanese, Chinese, all over the world, and they are borrowing those dollars from these foreign banks, these newly created dollars out of thin air. That is the Eurodollar system that Jeff Snider always talks about. That goes back to step number 1 and Bretton Woods, hashtag unintended consequences. Now we take it to the next step, which is the repo market. And for a lot of you sharp people, and all my viewers are sharp, but for the super sharp ones that noticed that last example of the dollar funding market, you're probably saying to yourself, that reminds me of the repo market. And you would be correct. The main dollar funding market. So all the main banks are at the top. I personally like my drawing a lot better, but this is a little more professional. So all the banks and dealers are at the top, and then the financial institutions and hedge funds, the way I draw them up on the board, they're right here. And government entities, financial institutions like Fannie and Freddie down here. So they're all lending to one another, and they're lending to the hedge funds, and all of the investors are lending to the banks, and these offshore entities are lending into the repo market as well. On the right, I'd like to point out that under the banks and the dealers, it's not just the U.S. banks, it's also the U.S. branches of foreign banks. So all of these dollars that are created outside the U.S. system and outside of the Federal Reserve by these foreign banks in the Eurodollar market system often find their way back into the U.S. dollar funding markets, more specifically the repo market. And it's crucial you have an idea of how this works, because this is a key component of the puzzle that we're going to be putting together in the rest of step number 2 and step number 3. So these euro dollars that are created outside of the US system in areas like Japan, China, and Europe provide a lot of the liquidity for the dollar funding markets within the United States. Fast forward to 2008, the majority of the collateral in the system that was being used in these funding markets was mortgage-backed securities. So when these things started to go bad, in other words, when that collateral started to become unusable, In 2007, 2008, that meant that there was a lot less, almost zero collateral in the system that otherwise would have been used. If there's a lot less collateral, that means they don't have access to the liquidity or the cash/dollars that they need to fund their operations on a day-to-day basis. What happens? Entity A, out of business. Entity B, out of business. And this problem reverberates out into not only Europe, but into the entire world, because a lot of the collateral that they had were mortgage-backed securities, just like the entities in the United States. We've all been told that what caused the global financial crisis in 2008 was a housing bubble in the United States and just a lot of garbage mortgages. But that's not true. The main problem is that we created a system that didn't have enough dollars in it compared to the amount of assets that it had. And to reiterate this, just in case you don't believe me, let's go straight to Jeff Snider.
I think it's also important to point out that this is not the first time we've seen this kind of tightening. This is actually the fourth time this has happened since 2008. The first one, obviously, everybody knew about. That was the global financial crisis in 2008. Everybody focused in on subprime mortgages, but that was only maybe the catalyst which kicked things off. We know from things like the global, the dollar swaps that the Federal Reserve did with the foreign central banks, that what really happened in 2008 was a global dollar shortage. Same kind of dollar shortage we're talking about today.
So the main problem, according to Jeff Snider, was not mortgage-backed securities. It was a dollar shortage in the system. And I would take it a step further and point out that really what he's saying is that the entire system is broken, and mortgage-backed securities back in 2007 and 2008 were only a small piece. That would have happened regardless of the housing bubble. It's just those garbage loans, those garbage mortgages were just the last straw that broke the camel's back. And you may be saying to yourself, George, that is crazy talk. I don't believe a word you are saying, because I've been told in every single history book, in every single class, in every single media outlet, that the housing bubble caused the financial crisis. And now that we've fixed lending standards, the whole system is fixed. What proof do I have? September 17th and the repo market. The repo market is the main dollar funding market. That broke on September 17th, just like it did in 2007 and 2008. The fact that we have just as much collateral, if not more, in the system today than we had in 2007 and 2008 shows us that the system is broken. It's not all about, it never was all about the mortgage-backed securities, and everything that we have been told is wrong. Step number 3. The global financial crisis we are still dealing with today, and unfortunately will most likely have to deal with in the future. The solution that the Fed came up with back in 2008 was, take a guess? Print money. You got it. They injected a massive amount of funny money into the system, which took the excess reserves in the banking system all the way up to a high of $2.6 trillion. Why is that a shocking number? Because if you look at the reserves or the excess reserves in the system prior to 2008, it looks like this. And you may be saying to yourself, George, it looks like there were no excess reserves in the system. And you would almost be right. If we pull up the chart, the Fred chart, editor, let's do that right now, we will notice that this entire line, the excess reserves, were around $1 or $2 billion, with a B, dollars in total, in the entire system. And you say, well, George, what on earth is this little teeny bump right there? I mean, that took the reserves all the way up to 20 billion. Keep in mind, 2.6 trillion at its peak, 1.5 trillion today. This crisis that forced the Fed to inject $20 billion into the system, which at the time was an astronomical amount of money, was none other than 9/11. My point is that the system functioned on its own perfectly prior to 2008. That was the Eurodollar system. Unfortunately, while it was functioning well, it was also sowing the seeds of its own demise. So now the green and the blue bar of each of the entities in the system has changed dramatically since 2008. A lot of the banks are flushed with cash or liquidity or dollars, whichever you prefer. But their assets, they've got a lot more of those as well for a variety of reasons, one being that we are in the everything bubble. But the market still freezes up. And I want to point out that the blow up in the repo market September 17th wasn't the first crack that we've seen in the system in the last few years. It's actually happened several times to varying degrees, but that's a completely separate video. Jeff Snider's take is that now, once again, there's a collateral issue. Keep in mind, he doesn't think that's the problem with the system. It's just another side effect. It's another cross current that we're seeing. So how it's working today is financial institution has these assets. That's the blue bar. If we take a closer look at these assets, we see that they consist of a lot of things that these primary dealer banks and other entities that are lending into the dollar funding markets probably don't want anything to do with. Mortgage-backed securities, for obvious reasons. Asset-backed securities, that would include subprime car loans. We know how bad those are right now. CDSs, credit default swaps, take that back to the blow-up in 2008. Or my favorite, OPA, oceanfront property in Arizona. The game that they're playing right now is something called rehypothecation and securities lending. So the way that works basically is this financial institution with all of the garbage assets will go to another financial institution or a bank that has collateral that is acceptable for the repo market, such as treasuries. And they'll trade them temporarily, these treasuries, for their GBSs or garbage-backed securities. Then this financial institution will take those treasuries that they don't own and put them into the dollar funding market, like the repo market. And that's where they'll get that cash, that liquidity, those dollars that they need to fund themselves on a day-to-day basis. Let's go right back to Jeff Snider for more of his amazing insights.
Collateral side is not an easy thing to explain because it's one of those things. It's part of the global framework of modern money. It's again the stuff that you were never taught in school, how it actually works. It's a very complicated, almost bizarre, weird kind of place. A lot of different things happen on the collateral side. It's something called securities lending. And even the idea of lending securities is probably foreign to most people because it sounds fantastic. And why would you be lending securities? And oh, by the way, we're not just lending securities, we're also transforming securities. So we have collateral lending, we have rehypothecation, we have collateral transformation, we have all these weird things going on that these dealer banks know is going on. Not only do they know it's going on, they probably have a decent idea of who it's going on with, and they also have an idea of how much this is taking place. And the way that they've done that is by various points along the way, they've transformed other forms of collateral, lesser forms of collateral, using the limited availability of the top tier stuff, the pristine collateral, and attempting to essentially get around what is this chronic shortage. But when you do that, you're adding elements of risk to the system.
Now we insert the Federal Reserve. We know that they came in and bailed out the repo market. They started to take all of the GBSs from all of these entities that the other private entities didn't want to deal with. They provided that liquidity. Why? Because they don't care how bad that collateral actually is because they don't have a profit and loss. All they're doing is spending your children's and grandchildren's future earning power. Right about now, your friend and family member Fred is saying, well, no problem. All we have to do is have the Fed continue to print money into the repo market. They can set up a standing repo facility, which means that they go in on a permanent basis. Or we can just have the federal government run massive deficits so we can get more treasuries or more pristine collateral into the system. Problem solved. But what they don't realize is the problem with a drug addict isn't that they don't have enough drugs. It's that they're addicted to drugs in the first place. Now let's check out a quick timeline so you can put all the macro pieces of the puzzle together. 1944, Bretton Woods. This forces countries to set up a Eurodollar system, which starts to financialize economies. It gets turbocharged by the USD going off the gold standard, becoming completely fiat in 1971. It gets more steroids when we go from an interest rate down cycle of 40 years, going from 18% all the way down to ZERP and NERP practiced almost worldwide. This takes us to the era of the global financial crisis that started in 2008 and we are still in now. The end result of this entire debacle has been a financialized economy that has taken over the world. And it all goes back to Bretton Woods. Hashtag unintended consequences. You may be asking yourself, yeah, George, but what is the solution? And it's something that I say all the time. Whether you back your currency with gold, Bitcoin, or any other commodity that the Fed and the government can't print out of thin air, you have to have a fixed supply of currency. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.